Assalamu alaikum, my dear students. I am Sadia Hussain, lecturer, Department of Finance and Banking. Today I am going to discuss short-term sources of finance, which is chapter 2. And I am going to discuss lecture number 2. My dear students, today I am going to discuss chapter 2, which is sources of finance. This is lecture number 2. Short-term source. At first, we have to understand the short-term sources of external finance. Short-term means less than 1 year. Most of the finances of an organization are usually collected from short-term sources which are repaid within a year. Benefits of short-term sources. In the case of short-term financing, an organization enjoys some benefits. First one is cost of capital from the short-term sources may be comparatively both the highest and the lowest. For example, loan collected from the commercial bank is required to pay high rate of interest in short term. Again, different interest fee sources like purchase on credit or wages kept due, a business organization can create fund for short term, which has no cost of capital. Then, second number one is the process of short term capital exchanges is the fastest and simple process. On the other hand, the exchange of mid-term and long-term financing requires to expend huge time and to follow long process. And third one is the business institutions whose products demand changes very swiftly within 1 year cannot make long-term plan of production and financing. For example, due to the rapid change of demand for the fashion house products, this type of business make plan for short-term production and thus require small amount of money at a time. Short-term sources of financing are suitable for this type of businesses. Institutional sources of short-term financing. First one is discounting bills receivable. When products are purchased on credit, the buying firm promises to the selling firm through signing a document to pay a specified amount of money after the expiry of the certain period, usually 3 months. So, the duration of bills receivable is 3 months. This type of document is called bill of exchange. This bill is receivable for the selling firm. So, selling firm can collect cash by exchanging or discounting this bill in a commercial bank. For example, on January, a buyer purchases goods of 500 taka on credit and agreed through signing the bill of exchange that he would be bound to pay 500 taka to the selling firm on March 30. In this condition, if the seller needs money before March 30, he can sell this bill to a bank before the expiry of the period, but he has to receive less than 500 taka. For example, with a discount rate of 3%, after discounting, he will receive 485 taka. This is discounting bills receivable. Then, bills payable. Bill of exchange is a bill receivable from the perspective of the seller, which is a bill payable to the buyers and is one of the sources of short-term finance. When a business institution purchases raw materials, production materials, etc. on credit, then finance inflows for a short term in the business. Because if business could not get the opportunity of credit purchasing, then finance would be required to buy on cash payment. Hence, if loan was collected from the bank, interest would have to be paid. Short-term bank loan. In the case of short-term finance, unsecured bank loan is one of the popular sources of finance. This kind of loan may be of different types. For example, in the case of short-term bank loan, usually interest with principal amount has to be repaid at a time after a specified time period. Many times bank tries to collect full portion or part of the sanctioned loan before the specified time period, and for this purpose bank gives discount on the total amount receivable as an incentive of earlier payment. For example, if a creditor repays 6,000 taka before the expiry of the credit term of 6 months, then he can give 2% less than the total amount. That means the creditor can repay 5,880 taka. Besides, if the creditor agrees to repay on demand instead of agreeing on a fixed term, this type of loan is called demand loan. The institutions which have alternative sources of finance can use this source at a low cost of capital. Bank overdraft. Bank overdraft is another type of short-term bank loan. Every institution usually realizes its receivables and repays its payables through current account. This type of a bank account mainly gives to its current account holders the opportunity of withdrawing more than the amount of savings in this account. However, the bank restricts the maximum amount of overdraft. Generally, finance collection from this type of source is a well-known system for those institutions where sales decrease for some time of a year. For example, it could be mentioned that an ice cream factory spends money throughout the year for production, warehousing, management, etc. But maximum amount of ice cream is sold in summer season. So, for the purpose of financing in other time of the year, this type of source can be used. Generally, in the case of other types of loan, interest has to be paid till the full repayment of loan. But interest for such types of loan has to be paid only when this loan is being used. However, the rate of interest of this type of loan is higher than the other types of loan, and it is repayable on demand. And last one is small credit. This type of loan is generally provided to meet the demand of current asset. For agriculture-based and small and cottage industry, such as management of small industry, purchasing of agriculture-based materials, management of a farm, etc., Grameen Bank, Youth Development Bank, cooperative banks are used to provide such kind of bank. This kind of loan is given step by step on the achievement of goal. My dear students, that's all for today's class. If you have any kind of questions or queries, you can call me or we can discuss in our Zoom class. Allah Hafiz.